In today's market update, we are going to check in on the stock market. It has roared back and recovered all of its Iran conflict losses. Also, there is a new kind of investment account that is going to be out this summer. We're going to tell you what it is and why it's important. And we've got a lot of other information also. Let's dive into it. Hey, before we get into our market update, just a thank you to our recent subscribers. We crossed over 4,000 subs in the last week. We really appreciate it. Thanks for watching. All right, we have a lot to talk about today, including starting with the fact that the stock market has now fully recovered from the Iran conflict sell-off. And we have a chart of the S&P, and this is over the last 3 to 4 years because we want to illustrate here that this was yet another V recovery from a sell-off. You can see there, let's start by looking at July and early August 2024. That was a pretty vicious sell-off in tech. The markets dropped between 11 and 17% and then recovered very, very quickly. Of course, go along to early 2025, the tariff sell-off that took place from March until early April. That one was vicious. The markets were down between 22 to 30%, depending on which index you were looking at. A lot of people believed we were going to get a recession. It was going to get very, very ugly for the stock market. But no, it just took about 2 months for the markets to recover fully from that bear market. And then you can look just in the last month and a half. We had a 10% sell-off in the S&P 500. Other parts of the market were down a lot more than that. And then a move straight up. We have another V recovery. And like I said, the S&P is fully recovered. It's not just the S&P. Tech, we talked a lot about tech. We had some videos about a month ago where we talked about tech, the best valuations in years, and we did not believe the tech run was over. The NASDAQ just had a 13-day winning streak, the longest winning streak in over 20 years, and it now has fully recovered from its sell-off. So listen, we're glad to see this. And now what is kind of taking the baton for the markets is not so much what's happening in Iran anymore. It's now earnings. We've heard from all the big banks who came out with very good numbers. And we also heard from pretty much all the CEOs that said that the consumer is still looking very strong and business investment is looking good. We like to hear that from them. We've heard from Delta and United Health and some other companies that have been really good. But in the next 2 weeks, we hear from tech. And that is something we will, as we do every quarter, recap all the companies that matter in a few weeks. Be on the lookout for that. It isn't very often that we get a new kind of investment account, but we're going to tell you about one that goes live this summer. And these are called Section 530A accounts, otherwise known as Trump accounts, which there are some of my clients that don't love the name there, so we set that aside. But these accounts are new and they were created from the One Big Beautiful Bill. We want to tell you some of the details about them. And we'll start off with this, that the intent of these were originally that the government was going to be putting $1,000 into the account of every child that is born. And this bill started that clock ticking January 1 of 2025. So if you had a child or you had a grandchild that was born any time from January 1, 2025 on, they are going to be getting $1,000 of seed money from the government. But as the legislation went on, these accounts are now more valuable than ever because now other people can add to them. And we'll put a couple of the key terms on your screen here for you to listen. And I should mention, In the link below in the description, we had a blog post that we did earlier in April where we went into some of the details of the Trump accounts and some of the key things that you need to know. But a few things that I wanted to highlight here, and one of them is that parents, grandparents, and anyone else can contribute up to $5,000 a year per child, and that can add up very, very quickly, especially when you consider the length of time that money's going to be in these accounts, because you cannot touch them. The child cannot touch them for 18 years. Until they turn 18, there are no exclusions. They are not to be touched then. But really, these are meant to grow for a lot longer length of time than that. Because listen, the money in these accounts are invested in the stock market. We put together a chart that illustrates how valuable time is for determining how much money's in the account and what can be made in the stock market. This chart you're looking at takes the $1,000 of seed money day one when you get a newborn and projects forward to the age of 59 and a half, earning an average return of 8% per year, which, listen, 10% a year is about the average the S&P 500 has had over long time frames. This is backing that down, being a little more conservative, assuming 8. But look at the value at the end of that period, $97,000 in the account. That is almost 100x the amount that was started with there. And this is a great thing. The more people that we can get making money in the stock market and getting to understand how powerful it is, the better. This could be a really cool tool. And by the way, that's assuming no additional money added. Going back, up to $5,000 can be added per year per child. Employers also have the ability to contribute, and we have heard of many employers, especially in the S&P 500, saying they are going to be contributing. They can do up to $2,500 per year, again, per employee, not per child there, per employee. So that employers can contribute and individuals can. The last thing I want to highlight here is contributions can begin on July 4th of 2026. There's going to be a lot of other details that we're going to be passing along in the months to come, including we are going to be doing a video that takes a look at these new Trump accounts alongside 529 plans and UTMA accounts. Previously, we had 2 tools available to help children save and invest. Now we have 3. We'll have a video out for that in the future. In our last market update video, we talked about the Red Book Index, which measures retail sales growth, and we get that number every week. We said that the numbers had been really strong, 7% year-over-year growth. Well, today we got the March retail sales numbers, and this backed up what the Red Book Index had to say. The headlines, 1.7% month-over-month growth in sales, and that was driven primarily by gasoline, which grew 15% month-over-month, 18% year-over-year. This is not a surprise. Because of what's happening in the Middle East, gasoline prices have gone up a lot, so people are spending a lot more at the pump. But what was really interesting is if you go deeper and strip out gasoline, that number grew at 0.6% month over month. That was the best number since January of 2023, over 3 years ago. And if we want to know what categories really powered that, you can see non-store retailers, which is mostly e-commerce, grew at 10% year over year, and that's one of the reasons that we love Shopify. They are the e-commerce king, and they've done a great job. It's been a great stock. This number is going to help them out when they come to their next earnings report. Clothing and accessories grew at 7% year over year, sporting goods 3.8%, and general merchandise 2.5%. Also, electronics grew at 5% year over year. So it was a very, very good month, which is interesting because consumer sentiment was very negative last month. In fact, it was one of the worst numbers in the last 20 years, which really you can point to. Consumers hate higher prices at the pump and anywhere else where they're paying higher prices. And so that drug down the consumer sentiment, but yet they turned around and spent. Now, speaking of spending, we are going to talk about government spending. And listen, this is a hot topic that we hear a lot of clients asking us questions about. And we are going to be having another video coming out in the next few months taking a look at this exact topic. We talked about this in the summer of 2024, where we look at the amount of government debt that's out there, the amount of spending, revenue brought in, the dollar. There's a lot of concerns that come about, and we have the numbers to cut through the clutter and the political spin to tell you what's really going on. Let's give you a tease today by taking a look at a chart that takes a look at the amount of government spending as a percentage of the U.S. economy, GDP. And this goes back to 1947. And we're going to get into the blue dots in just a minute. But what we can tell you now that really stands out is the huge spike when COVID hit. We know that the government spent trillions and trillions of dollars during that period of time, and we had never encountered anything quite like this. That has since come back down, but is still relatively high. It's sitting at 24% of the U.S. economy right now, and the historical average is more around 21%. So the government is still spending a lot more than they have historically. But for today, what I really want to focus on are the numbers below that basically says it takes a look at three different categories. Category number one is when government spending has been above the level of 21.4%. And it tells you jobs, non-farm payrolls, jobs grew at 1.4%. Business investment grew at 4%, and then real GDP, that's the growth rate here for the economy, grew at 2.7. Now, when you go down, so less spending, that's the area between the two blue dots. Notice growth picks up, business investment picks up, and the economy grows at a faster clip. And then lastly, if you go below the level of blue spending, so the government spending a lot less, well, lo and behold, jobs growth is much, much stronger, 2.1%. Business investment goes up a lot, and then real GDP goes from 3% to 4%, which that is a massive, massive difference. So this is saying, history going back to 1947, when the government spends a lot more money as related to the size of the economy, it has a negative impact on jobs, on business investment, and on the growth of the economy as a whole. As they spend less, all those things improve. This is a very interesting chart. We'll talk about it more again in our future video on the government and government spending, but we wanted to give you a tease today. All right, our last topic, we are going to talk about the nominee for the new Fed chair, Kevin Warsh, and we're filming this on April 21st. Today, he had his hearing in front of the Senate committee, which is got to be a very challenging task for anybody who wants to be Fed chairman, sitting and hearing from senators, and then he has to do the same thing for the House of Representatives if he gets the job, and hear their questions in the grandstanding that they love to hear themselves talk. But nonetheless, Here's what you need to know, because this is going to be an important factor in the next month, is does Kevin Warsh get confirmed? A lot of people feel like he will. So we wanted to tell you just a couple of key things about him. The first is he is crisis tested. He was around on the Fed during the financial crisis of 08-09. In fact, he was the youngest member of the committee at the time, so he had a front seat there to see what took place there in what was arguably one of the most challenging periods in the last 100 years for the Fed. So someone who's been through that, you feel good about their ability to go through a crisis in the future should that happen. Point two that I want to highlight here is that he has deep financial markets expertise. He spent a lot of time in the financial markets, so he knows how markets work versus just being in academia. And we've seen that the Treasury Secretary, Scott Bessent, that has been a very good pick. He's done a very good job. He came in also with a lot of experience from the private markets, not from academia, and that helps the financial markets feel better about how they will respond. And then the last point that we want to make here is that he has in his career both been what's called hawkish and dovish, and that is very rare to find. And what we mean by that, hawkish means you're hesitant to cut interest rates. You're more in favor of rates going up. Dovish means you want rates to come down more aggressively. And so we like to see someone who has been on both sides, because there are a lot of people who just take one side and that's what they believe at all times. And to get somebody who's going to do a good job at the Fed, you want someone who is going to look at the situation and is not married to one side. All right, so the key takeaways are the stock market has been on fire in April. It's performing much better than it did in March. And then we talked about the new type of investment account called the Trump account. These go live on July 4th. You can head over to our blog to see our post on that. And while you're on the website, check out other information on ourselves, and don't forget to follow our socials, YouTube, Instagram, and Facebook. Well, thanks for watching and take care.